The S&P 500 distributed $118 billion in dividend payments in quarter two of 2019, which is up 6.3% from the 111 paid out in quarter two 2018. I don't see how you could look at that as anything but positive. I just don't. The index buybacks totaled about 164 billion preliminary in quarter two 2019, which is down 13.7% from quarter two 2018 and down 26% from an all-time high. All right, but it's still in the billions. I mean, look at all that cash. 164, that's just a quarter billion of buybacks, 118 billion of dividends. I just don't get how you could look at that as anything but a positive sign. That's a lot of cash that's being sent back to the shareholders, either through appreciation or reducing the demand or reducing the supply of stocks, and certainly with the dividends. I don't see how that could be anything but a good thing. So let's. I want to look at another report here because we got something from Brian Westbury, and I want to share that with you. Hold on just a second. But before, I want to show you, here's Ray Dalio warns of serious problems in a bond blow-off as a repeat of the 1930s. That's just odd to me. Ray Dalio is worried that the current landscape is starting to resemble Depression-era conditions that could hammer investors. In a LinkedIn post, he said high levels of debt and central banks' ineffectiveness are two of the key factors that need watching. Is there high levels of debt relative to the late 1920s? I don't know. Relative to the mid-2000s? I don't think so. When there's an economic downturn that will produce serious problems in ways that are analogous to the ways of the confluence of those three influences produced serious problems in the late 1930s. The post was consistent with a previous warning. Come here, buddy. In which he thinks gold will serve as a profitable hedge as investors get hot holding too much risk. I don't see that. So the 1930s were deflationary. We have massive amounts of money going back to dividends through shareholder buybacks and dividends as well. Whereas I don't get it. I don't get how you can say that's deflationary. But then he's going to say later on it's kind of inflationary. They're going to, because he says in the latest essay, he spoke about central banks are being forced to keep interest rates low and print money to buy financial assets in order to prop up markets and make huge fiscal deficits affordable. He said there are strong, this doesn't make sense. How are you printing money to buy financial assets and not making it inflationary? And there are strong deflationary forces at work. I literally don't understand. We're printing money, but instead of being inflationary as deflationary, I fall on the side of the deflationary bandwagon more so than the inflationary bandwagon. But printing money, how is that deflationary? These forces are creating the need for extremely loose monetary policies. Come here, bud. All right, hold on a second. Let me get my co-host here. These forces are creating the need for extremely loose monetary policies that are forcing central banks to drive interest rates to such low levels and will lead to enormous deficits that are monetized, which is creating a blow-off in bonds that's reciprocal of the 1980 to 82 blow-off of gold. I literally don't understand I don't understand that. So we're going to have loose monetary supply, loose monetary policies, and printing money to buy financial assets, and those are strong deflationary forces at work? That makes no sense to me. Look, I don't understand that. All right. He directed his readers to study the economic investing conditions of 1935 and 1943, as there was a lot to be learned by understanding the mechanisms, what happened then, analogous times before then, in order to understand the mechanics of what is happening now. I don't get it. So anyway, let's just go back to Brian Westbury here, and I want to share with you. Hold on, let me find this article. Hold on just a second. I just saw one. Bear with me just one sec. Industrial production increased 0.6% in August, which, all right, let's just read this. Industrial production surged in August, easily beating consensus expectations to post its largest monthly increase in a year. And the details of the report were as good as the headline, with nearly every major category showing growth. The one exception came from auto manufacturing, which fell 1% in August. However, that comes on the heels of 3 consecutive months of strong gains, and auto production still 1% from a year ago. Meanwhile, the best news came from manufacturing outside the auto sector, which represents the majority of manufacturing activity, whose production rose 0.6%, is largely monthly gain in over a year. Putting the two series together shows overall manufacturing increased by 0.5% in August, but is still down 0.5% from a year ago. This represents a considerable slowdown in the 12-month growth rate since the end of 2018, and the same pattern can be seen in overall industrial production at this chart above shows. You can see pretty significant draw. We got pretty significant uptick, pretty significant downtick. Let's see. However, the slowdown has begun to taper off, and there's evidence that the manufacturing activity may be turning a quarter. Over the past 4 months, manufacturing has risen at a 2.6% annualized rate, a stark reversal from an annualized decline of 5.8% during the first 4 months of 2019. So despite all the recent doomsday predictions related to the China trade dispute, it's important to remember that we also saw a similar slowdown in 2016 and 15 and 16 during the oil price crash, and no recession materialized. Keep in mind that manufacturing is only responsible for about 11% of total GDP and is much more sensitive to global demand than other sectors of the economy. Finally, mining activity rebounded 1.4% in August, following a sharp temporary decline in July due to Hurricane Barry. In the past year, mining is still up 5.1%, showing the fastest year-over-year growth of any major category. Expect a further acceleration in the coming months as the U.S. shale drillers, drill baby drill, ramp up activity to fill the gap in production caused by the recent attacks on Saudi Arabia's oil infrastructure. Yep, I agree. Let's see. And that's so anyway. The point about this that none of this is recessionary necessary. Inherent recessionary. The dividends going. That's a freaking fantastic thing. I don't get Ray Dalio saying we're going to have deflation with the loosening of the monetary supply on top of the printing of money. That just doesn't make sense to me. So lots to be happy for. Should you make an investment decision on any one report? No, but I mean, come on, man. Dividends going up by that amount of money is a huge deal, and we want to take advantage of that for sure. There's lots of cash on the side. It's going to be deployed one way or the other. Reinvesting of dividends or sending as dividends to shareholders or buyback in shares. Both of those are net positive for shareholders for sure. All right, we'll see you.